Good day and welcome to yet another one of our Rand Swiss weekly wraps. As usual, we'll go over the stuff that happened this week and talk about how it might affect you and your investments. We're going to have three topics this week. The first is US CPI. Then we're going to talk as well about what's happening in the UK at the moment. And finally, a little wrap up of the Russia-Ukraine situation. Our deep dive is actually going to be into the US CPI, so that'll be the longest part. The rest of it will just be a couple of short takes on what's happening. Okay, so firstly, starting off with Russia and the Ukraine. Last weekend, the Ukrainians blew up a major bridge that connected Russia to Crimea. Crimea is one of the provinces that the Russians first took many years ago from the Ukrainians, and it's a key, part of what they consider to be the interest in the Ukraine. The bridge wasn't fully destroyed, but it was out of commission to a large extent for a few days. In response, the Russians responded with significant attacks across major cities across the whole of the Ukraine, pretty much to show that they could attack anywhere in the Ukraine they wanted to at any time. There's also talk that they've gotten more aggressive with regards to their strategy. Some people that were, especially one particular commander that was well known for his brutality in Syria, has been appointed in the Ukraine. So we are likely to see, an uptick in the level of violence. At the same time, we are seeing the Ukrainians come out and ask for more help from the Americans and the Europeans to a certain extent. The Europeans, to a large extent, are almost insignificant. The Germans are doing almost nothing. The French are doing a bit more. The UK is doing a bit more, but none of them compared to what the US is willing to do. In fact, the biggest supporters of the Ukraine in Europe are actually some of the poorer Eastern European countries that really don't have the capacity to help in a large extent. Now, looking at what we expect to have going forward, it would mean to be seen what's going to happen with that particular, thing in the Ukrainian counteroffensive. We don't know just how long they can last on this thing. They've been pushing very hard, very quickly, really outperformed expectations as they have done throughout this entire war. But winter is coming soon to the Ukraine, and it's thought that we might be seeing a bit of a halt or almost a stalemate during the winter. That is something I think that we have to look forward to. At the same time, winter is also going to come to Europe. It's going to come and obviously affect things like, for instance, the energy situation. And I do think that that's going to be a key component. If the Europeans are really going to be suffering through the winters, it's going to create a lot more incentive for them to basically back down to Russian demands. The next thing, what's happening in the UK? Okay, this week the UK basically cancels or ends its bond buying program, a temporary program that they had for 2 weeks in place. That program was meant to be there to actually help the UK avoid a crisis in their bond market. It was, intervene, stop this downward spiral, and for 2 weeks, and then hopefully things will have calmed down by then, and we can basically return to normal. It seems unlikely it's going to happen. They've actually had to intervene not just that one time, but multiple times on the 2 week period. So we've seen that the market is actually quite nervous at the moment, and this small period of intervention is probably not going to be enough to get them out of this particular trap. So what's actually happened right now is that we are seeing the implementation of something called a TECRF, which is a new program that they're going to be putting in place to try and help support the bond market. It remains to be seen just what can be done. Is this a fundamentally strong market with illiquidity causing issues, or are there some structural issues in this bond market that is going to take forever to solve? I do believe that some of the stuff that we saw over the last couple of weeks is going to basically change the way the market works. For those that don't know, one of the things that really triggered the whole thing was something called LDI, which is liability-driven investments, which is what what pension funds engage in, because they have these big liabilities well into the future, and so they try to hedge themselves against any kind of market fluctuation to make sure that they can pay for their liabilities. The problem is when you have fluctuations that are too great, what happens is actually the stuff that you put in place to protect yourself becomes a hindrance. And whereas normally they might have a few weeks to basically act to certain moves, they were given a few hours, and the market was able to handle the volatility. But what could happen after this particular situation is over, even if it's solved, is that I don't think that the UK pension industry is going to be as keen to return to the levels of LDI they had before. And I think that's going to cause a fundamental shift in just how that industry behaves going forward from here. Also, we had news this week that apparently there was a rumor, not confirmed, as I recall this, that Liz Truss and her Chancellor the Exchequer were looking to change, some of the tax policy, to kind of back down on it. Things like tax cuts. She's following a very supply side kind of policy where she's looking to cut taxes to boost growth, and that she might be looking to reverse that. The market reacted quite positively on that. So I'm taking that as a sign that perhaps the market is looking for an excuse to rally up, because there's very little backing in any kind of news source that was giving some firm foundation to why they'd to this story, basically. So this was just a rumor, and the market reacted quite positively to it. So I do think the market right now is looking for a reason to go up in the UK, but like I said, we need to see some calm return first. Without that calm, things remain to be quite choppy and perhaps even negative. And finally, into our deep dive for the week, which is the US CPI number. So the US CPI number has come out, and it's basically coming higher than expected. This follows the day after we had the US PPI number, the production inflation number, coming in again higher than expected. The driver, one of the biggest drivers for the CPI number, the consumer number, was actually housing, shelter. That remains quite high. This is to a certain extent an artifact of the way they collect these prices. I mean, I've discussed before the way that they collect prices, for instance, for medical inflation, that's quite lagging. They also got those same kind of things coming through for housing inflation as well, which also lags to a certain extent. It's a very unusual system that they're using, or a non-intuitive system, let me say, that they're using regarding basically assumed rental for properties and so on. For instance, the medical thing was not directly medical costs, but basically the difference between the amount of money that the insurers collect and how much they are paying out in premiums. So this is a very difficult kind of section to basically intuitively understand, and some of the kind of disappointment, some of these effects that we are seeing come through are artifacts. They may not reflect the underlying economy. That being said, as I've said many times in the past, the one thing the Fed cannot do is be shown to be weak in the face of inflation. Right now, inflation remains higher than they want. Right now, inflation remains higher than the market expects it to be. In those scenarios, the Fed has to act aggressively, okay? Because part of its power is its threat. And though the threat may not be justified in some instances, if you don't do the threat, you don't follow up on the threat, you diminish your credibility with the market. The Fed has to have that threat, because that gives it a lot of its power in terms of how it influences and kind of creates market conditions to its liking. And if it basically loses it, it's going to make it much more difficult in the future, much more costly in the future to actually act on the market. So the Fed has to respond to these CPI numbers, even though, like I said, these CPI numbers are likely to be not quite what the market's doing because of these artifact effects. At the same time, we've seen the jobless numbers come in, unemployment numbers come in basically last week higher than expected. We also had jobless claims slightly higher than expected. So the the employment sector seems to be in really rude health at the moment. So what needs to be done is the Fed needs to see some weakness in the economy, and needs to see inflation come down, at least start basically being lower than expectations as opposed to continuously being higher than expectations. Until we see that, the Fed is going to be forced to act more aggressively, perhaps more aggressively than is justified by the fundamentals. But I think in terms of this situation, the fundamentals matter, but longer term, the reputation, the credibility matters more. 10 years from now, 20 years from now, the Fed will still need to rely on its credibility, even though it may have misstepped right now by being too aggressive in the face of inflation and in the face of reasonably strong employment. Okay, and now one more thing when it comes to inflation. Remember, I had a discussion with you guys a while back about inflation. One of the major costs of inflation really comes through when inflation surprises the upside. If we knew, for instance, that inflation was going to be 10% every year for the next 10 years, and it was always 10% when we were pretty much sure about that, we would all just adjust to it quite easily. It would not be a major impact on the economy. It would not be a major impact on the market. But if we see inflation, say, at 10% for the next, say, while, or expect to be 10%, and it comes in at 11 continuously, well, then that really does change the way the market reacts to it. Because it's actually that misestimation that really costs the market. Because what happens is, when people estimate the inflation rate next year to be say, for instance, 10%, and it's actually going to be, say, 12%, they are going to be worse off in certain circumstances. When certain circumstances, for instance, they've negotiated the wages, where they've negotiated prices for their products, where they've planned for costs and so on going forward. If they don't get that right, and they get it right in a way that the inflation comes in higher than they anticipate, they're going to feel a lot of pain. So inflation higher than anticipated is going to cause a lot more pain than inflation lower than anticipated. Inflation becoming lower than anticipated, even if it's quantized. For instance, we were expecting 12 and we get 10, okay? the market's going to be reacting quite positively. Why? Because they budgeted for 12. So you budgeted for 12 for next year. You basically had your wages increase by 12% next year. You had your prices increase by 12% next year. And it comes in at 10. It's a positive surprise. And that positive surprise is going to be beneficial to the economy and to the market. The fact that we are seeing inflation continuously miss the upside, even though it's coming down, people are anticipating inflation to fall faster than it actually is. It's continuously being higher than anticipated. That is one of the real costs of inflation. It's going to cause people to suffer economically. It's going to cause companies to suffer economically, and it's going to cause more uncertainty in the market. And that's going to be one of the real big costs that we're going to see going forward. And again, if people are continuously disappointed at the upside for inflation, they are going to adjust their inflation expectations. And when you adjust your inflation expectations, guess what happens? Temporary transitory inflation caused by supply shocks, etc., becomes embedded inflation that continues unless you do something to break it. Okay, that's me for the week. Look forward to speaking to you guys again next week, and have a good weekend. Cheers.